Hello, everyone, and thank you very much for joining us on this particularly sort of important webinar that we're sort of going to run through the sort of current market conditions, really. In partnership, we're here with Conor at GetGround, who's going to give you some really good insight into sort of essentially looking at the most tax efficient ways to purchase the property that you're potentially looking at in the UK.
Yes, thank you very much, Elliot, for having me on.
No problem at all. As mentioned, I'm Elliot Rowe, part of the RPA group, and this is Conor Kilcoyne from GetGround. Conor and I are both based out in the Middle East, and here essentially to support buyers from all over the world, essentially looking back at purchasing UK property. Just a quick sort of overview of actually what the RPA group do, and I'll run through sort of the current market conditions, and then pass you over to Conor, who will then go into a bit of a deep dive into GetGround and exactly what they do. The RPA group, as sort of mentioned a few seconds ago, we essentially are based in Dubai, but we're here to assist overseas purchasers, overseas investors, purchase and invest into the UK property market. We are able to help sort of a 360-degree solution. So we are here to help at every step along the way, and offering advice, and also partner with experts like Conor in specific areas of the market, and ultimately giving you the widest spectrum of the market, and essentially the best ways to access it, and to continue to ultimately get the best returns out of your investment. So in terms of today's topics and what we're really going to touch on, obviously we had a budget in the UK a couple of weeks ago now, and then there were some changes there that will have an impact on the market. So we're going to look at those tax changes. Also, and very much on Conor's side here, looking at the most efficient way to purchase property in the UK. I'll touch on what's happened with the effect that the budget's had on mortgage rates, and also other elements. We had a Bank of England base rate change again last week. So again, there are other factors other than just the budget that affect the market. I'll look back at sort of what's happened this year in the UK market, and what we're expecting to see in 2025 and actually beyond. There's some really interesting points that have been coming out in the recent days, actually, on that, and then also I will touch on. I won't go into too much detail, but I'm going to touch on some of the hotspots where we see the capital appreciation and sort of the rental growth areas in the UK, and ultimately, we can have deeper, longer conversations about that, offline. But I'll give you a few snippets of where we think are sort of the best places to have a look at. So looking back over sort of now, we're coming towards the end of 2024, and it's been really quite an interesting year in many ways. So we've came out of the end of 2023 and moving into 24, where we had quite high inflation. We had a year of interest rates increasing in 2023, and actually 2024 started to saw that actually stabilize. We saw a very positive. We've seen a very positive movement in terms of where the housing market has gone. The inflation actually got to its target of 2% in May 2024. We're now actually seeing inflation sit down below 2% at 1.7%. We started to see the mortgage markets sort of reflect that as well. So we started to move into a much more positive market. We've seen house prices increase this year. We've seen transaction levels equally increase. Just to put a point on that, we started to see that transactions in comparison to, say, pre-pandemic levels significantly increase. A statistic I read today is that it's up 62% October of 2024 compared to October 2017. So real positive moves and strides forward in terms of transaction levels, in terms of activity, and there are strangely significant elements that we thought may actually make the market struggle. But actually, we've actually seen how robust the UK property market is, and we've seen how it's been able to cope with sort of outsized significant elements. So from an economic perspective, a government perspective, a political perspective, and actually the robustness of the market and it's going from strength to strength. Ultimately, and I'm sure for many of you that have sort of listened to me before or seen me before, what a lot of this comes down to is the supply and demand in the UK, and it continues to be at all-time low levels. Just looking on this slide as well, and I know I sort of jumping around a little bit here, but on the mortgage rates perspective, when we're looking at compared to a year ago now, the sort of your standard rate, say, was at 5.25%. We're now down to 4.57. Sorry, the bank rate was at 5.25%. It's now down at 4.75%, and so therefore we started to see your typical rates and that side of things go from a year ago at 5%, almost dropping by 1%. Now, these rates were sort of typically for your UK-based investor, but equally, you've seen significant drops for your overseas investors as well. And ultimately, what all this has done, and with the fact that now we've had a government change, we've also had a new budget, that people have now have a bit of clarity on what's going to happen moving forward. And like what happens in the UK market, and sort of when we see house prices say a little sort of stabilize or even maybe drop a little bit, is that the reason for that is because transaction levels drop, and that people are unsure, and so therefore don't necessarily transact. Now we have some clarity on what's going to happen moving forward. Now we've started to see inflation drop. We started to see the base rate drop in terms of interest rates. With the market is starting to pick up. And actually, what all sort of analysts and that sort of things now are saying, moving forward from now into 2025 and beyond, is we're actually looking at seeing a much stronger market in the UK. So we look at that over the next 5 years up to 2029. The UK average is looking at an increase of 23%, Northwest up at 28, West Midlands 26, as you can see here from the graph, from this slide, 24%, and down to London, which is looking about 17%. These rates are actually from JLL. Savills released their report yesterday, and they're a little bit more punchy with their thoughts. And I think they're looking at, like, say, overall in the UK 25%. Northwest is looking at overall about 30%, and then the other figures are very similar. Ultimately, what this is meaning is we're moving into a time of growth in the UK. The supply element is still, as I keep mentioning, low. We have clarity now on what's going to be happening moving forward. There is a new government in place. We've obviously in the US seen similar scenarios. So again, there is stability over what's happening there in the next 4 years, in terms of who's going to be in the leadership side of things is going to be over the next 4 years. So people have more faith and are now getting back into the market, and that's what's going to see things move forward at a sort of rate of knots. With that's all sort of based on capital appreciation and that side of things. And that's predominantly what I'm talking about with house prices. But obviously, with that, and a key element to obviously buying an investment property in the UK is the rent. And what's going to happen there is your yield going to improve as well. Our rent's going to go up. Now, the short answer is yes. You can see here we're expecting a rise of 17% by 2029. A key element of that again is the availability of rental properties in the UK. So there is a continuing growing population. There is the the price point of property is continually going up, and therefore it's more expensive for first-time buyers to get into the market. So therefore people are renting for a longer time. Typically 10 15 years ago, I think the average age of purchasing a property was 32 to 35, and now you're looking at sort of 35 to 40. So you really that average age is increasing and increasing all the time. So therefore your rental pool is actually it is growing. So but then less property, so therefore rentals continue to go up. For those of you that read the budget or listened to it and have had some significant and understood what happened, there were two sort of significant changes for overseas buyers really purchasing UK property. The first one was there is an additional 2% on the SDLT, the stamp duty land tax. Stamp duty land tax is a one-off payment that you pay to the government on completion of a property. Essentially what that means for your average property price at which is circa £300,000 is that there is an additional £6,000 purchase cost on the property. And sort of in a more general term, and just so everyone you can understand your figures and that side of things, that your SDLT on completion for an overseas buyer that doesn't have a UK passport is going to be circa 7%, bringing itself much more in line with the likes of the purchasing in Dubai or in the States, in Australia, where they have still have higher initial purchasing costs when you're looking at property. Conor's going to touch on this in a bit more detail, but you can obviously read from the slide here that there is a misconception in terms of capital gains tax that did not change for did not change for property as an asset class, where other asset classes did change. Ultimately, what that means is it gives us that more stability in the market, again, because we know that when we're looking at selling the property, there is less of a nothing has changed from now to last year or the year before. Conor, have you got anything to add on that?
Yeah, thanks, Elliot. You're spot on, and just to kind of touch on or highlight a couple of things around SDLT and CGT, and to maybe marry the two together. So there's a misconception in the market that there has been an increase in CGT, as you said, for the sale of shares. So if you own a property specific or a rental business, that's not applicable, and you're subject to stamp duty land tax. And yes, there has been an increase in stamp duty land tax. So the surcharge previously of 3% on SDLT has increased. And as you're saying, for overseas buyers, we're looking at circa 7%. However, again, Elliot, as you alluded to, the supply and demand imbalance in the property market remains, a massive factor. And if I was to look at it with a slightly different view, if you're going through a transaction, if you're going through a purchase currently, a number of our clients have been able to negotiate on completion. So it gives you a little bit of negotiating power if you're coming close, if you're buying, secondhand property, if you're buying something or you're coming close to completion. As well, if you're buying something, potentially off plan, it gives you that I guess that additional time to come up with the additional stamp duty. And the last point I will note is with regards to your exit strategy, and something that a lot of people don't necessarily know within the industry and within the market, is that stamp duty can be offset at the point of exit. So capital gains tax is not increased, and stamp duty, the increase in stamp duty can be offset at the point of exit. So that comes off your taxable capital gain. So I mean, I know it's not solving all the problems, and if you're in it for a medium to long term, it makes a little difference to the upfront cost, but it is something just to note that the stamp duty land tax can be offset at the point of exit.
Yeah, perfect. That's really helpful. And obviously, yeah, wherever we can save on tax, the better. Something makes the total investment.
And just the last point, Elliot, you touched on the overseas market, and if we do look at the international market, and now I've, as you know, or as you said, Elliot, I've relocated to Dubai. I've spent some time recently in Hong Kong, spent some time in Singapore, and if we're to compare the UK market to other international markets, there's huge international push factors. So several foreign countries are experiencing push factors, and that typically will influence capital flows into the UK property market. An example of this, and historically the two biggest markets, or the best performing markets for the UK, have been Singapore and Hong Kong. And if you're to look to invest in Singapore, there's a stamp duty of 60%. And Hong Kong is seeing capital outflows due to, as we know, the growing Chinese influence. So UK as a property market for overseas investors is still unbelievably strong, and is probably the most resilient asset class currently, and has been historically for decades, if not centuries. It's just another point to come in on.
Yeah, absolutely. It's brilliant. That's really good. I didn't actually realise Singapore was 60%, so that is quite interesting.
Yeah.
That's crazy. Okay, so moving on. Okay, as I said, look, I want this to be informative, and I want this to sort of be a bite size in many ways. But as I mentioned, we specialize in sort of areas within the UK where we feel there's going to be capital appreciation and a strong rental yield. Now, at the moment, and from the statistics that we're getting, is sort of key major cities. London looking really good value now. Manchester, and London's the reason London's looking good value is because your rents are still increasing, prices haven't, so you're actually getting strong rental yields in London. Manchester, as I say, is looking at the best growth in the country from a capital appreciation perspective over the next 5 years at between 28 and 30%. And Birmingham is the second area where we're expecting to see the most growth from a capital appreciation perspective. So on that note, we have projects in London, Manchester, and Birmingham. In Manchester, a fantastic project we're doing with a very large developer, FEC. Prices starting from 250,000, completion in 2028, and with a very attractive payment plan. Jewelry Quarter in Birmingham Sloane Court. This is completing next year, the Q2, Q3 2025. Again, one beds from that sort of circa 250,000. Fantastic development. The last phase of a project that we've been involved with from the outset, and has an incredibly good investment case. And the evidence to show that with the previous phases that we have sold. And finally, if you're looking at something that's sort of a high-end exclusive development really that we have here called Aspen in Canary Wharf. It's a hotel residence connected to a hotel, an absolutely fantastic project with all the amenities, all bells and whistles. That's completing at the moment, so you wanted to get a return on your investment ASAP, then this is something that you should certainly look at. Excuse me. So I've touched on sort of product, current market conditions, and now I'm going to pass over to Conor, who is going to run you through GetGround and then essentially the most efficient way to purchase property.
Thanks, Elliot. So some of you may have heard of GetGround, some of you may be clients, but I'll kind of start from the beginning and give you a bit of an overview of who I am and I guess who GetGround is. So I'm Conor Kilcoyne. I'm the head of international partnerships at GetGround. I've been at GetGround for over 3.5 years. And I am based here in Dubai. We've also got offices in Hong Kong, Singapore, and we've got a significant presence in the UK, with our HQ being in Hammersmith in London. But in short, GetGround specializes in the setting up of limited companies for investors, buy-to-let investors in the UK. A stat that I typically like to open up with, and one that I think speaks volumes for the market currently, is that last year, or over the last 12 months, over 65% of all buy-to-lets in the UK were done so via limited company structure. And traditionally, the setting up of a limited company and certainly the ongoing management of that company would be seen to be, very long-winded, very taxing, and very costly for the investor, which would see you have to instruct a solicitor, an accountant, even a tax advisor when you want to extract that income efficiently from the company. It could take you anywhere between 3 to 6 weeks to have the company incorporated, and then could cost you anywhere between £1,500 to £2,500 for the ongoing management of that company. At GetGround, what we do, and we do this by leveraging technology and softwares, we make it super efficient and super easy. So you can have companies incorporated in kind of 2 to 3 working days, depending on where you're based. And it's cost effective, and I'll come to a lot of that in a second. But yeah, so that's a bit of an overview really on GetGround as a whole. And then just I'll just go back there if that's right. Thank you. Then just kind of some further points to note. So we've transacted on over £1.6 billion in UK property on our platform. We've got well over 30,000 active customers and a database of over 80,000 property investors. We have a network of partners of give or take 1,500, and as I said, we've got offices worldwide: UK, Hong Kong, Singapore, Dubai. So really, depending on where you're based, time zones, in some cases, what language. We've got Cantonese, Mandarin, French, Spanish, Portuguese speaking. So really, depending, we can always accommodate and we can always facilitate. Well, as you know, GetGround and RPA, we're in the property investment space, and really what we're trying to do is help you grow or create wealth through property. And again, some of you will probably know this, and this won't come as new. But there are key benefits in property as an asset class, and I'm going to touch on these now super quick. But there's obviously rental income, it's inflation proofed, capital growth. You can leverage through mortgages, multiply returns by circa 3, coming close on 3% or 3x, and then 3% market growth, and that's a really, really conservative figure. 3% market growth will give you an 8.1% ROC. So it's a super beneficial asset class, and then the features are that it's a tangible asset, easy to understand, and controllable and flexible. But what's the core purpose of GetGround? What's our core product? Our core product is the setting up and management of limited company structures. So limited company for property investing. And what are the kind of the key, or what is exactly that we will do for you as a client? So GetGround will set up a UK limited company for you. With that, we provide a business account for all your property expenses. And within the business account, we've got different financial services, the likes of investment pots. And then we look after the company thereafter. So we look after all of your ongoing accounts, tax filing, secretarial services, post management, and then management of registered office address in the UK. And why that's a really, really important point to note for any overseas investors, which I'm sure the majority of people on this webinar are, is if you're looking to purchase property in the UK, you might struggle because you can't set up a bank account. Why can't you set up a bank account? It's because you've got no registered address in the UK. And we can solve all those problems super quick by setting up a UK limited company or incorporating a UK limited company. We provide the business account and we allocate the registered address. So super efficient way for any overseas investor looking to purchase property in the UK for investment. But still our split is 50 UK, 50% overseas. So really depending where you are, we can always help. So why would one use a limited company? There's a whole heap of benefits, and I'm going to kind of touch on the key points, and then on the next slide go into a little bit more detail around tax efficiencies. But the first is that there is a massive gain in tax efficiency. You limit your personal liability. You can buy and sell property easily, improve estate and inheritance planning, and then access to really well-developed mortgage markets. And Elliot's going to touch on mortgage markets in a second. But really, it can help you, especially as an overseas investor, gain access to top mortgage markets. But the main reason why investors like yourselves and clients, etc., landlords look to set up limited companies are the tax advantages that come with. And I'm going to touch on the key points here. And the first is around stamp duty land tax. And what actually is a misconception in the UK, this is separate to the increase in surcharge or anything like that or anything in the media, but what is a misconception in the UK is that it's often believed that you pay a higher level of stamp duty land tax when buying a buy-to-let in a company structure. So it's actually false. You pay the same level of stamp duty land tax if you're buying a buy-to-let in a company or if you're to do it in your personal name. It's not necessarily a gain there in the first instance, but more so, level playing field. And what I'm doing here is I'm comparing, because the two options for you in buying a buy-to-let in the UK is to own it in a company or to own it in your personal name. This next will be seen as probably being, the most attractive advantage, maybe the most lucrative saving you're going to make. And that is that you can deduct all of your mortgage interest from your UK tax bill, as well as any other business expense. Your service charge, your ground rent, your management, your maintenance, any business expense, as well as your mortgage interest, can be deducted from your UK tax bill, and you avoid paying what's called a basic rate credit. So to do some quick maths, on average 40% of the rental income goes toward mortgage interest and expenses, and through a company structure they are tax deductible. So you'll be paying corporation tax on the outstanding 60% in using this example. As opposed to owning property in your personal name, where you pay tax on the 100% at income tax level, and then all of your expenses and mortgage interest are deducted. So it's a really big saving, and it's the key one to note. You can efficiently take income from your property and avoid paying income tax. So we would structure this by way of an owner's loan or director's loan. We can extract by way of dividend, and depending on where you're based, obviously it's incredibly tax efficient in places like the UAE and places like Hong Kong and Singapore, where there's no dividend tax on arrival. Or we can contribute towards your pension as well. So really depending on what your goals are, we can sit down and discuss the different options. But yeah, again, you can efficiently take income from your property. This next point is a point I forgot to note when we were discussing the changes, but there is no change in stamp duty land tax for the sale of shares, right? So when you go to sell, if you bought the property in a company and you go to exit or you go to sell, your future buyer can avoid paying stamp duty land tax. In the UK, as we know, and has been highlighted over the last couple of weeks, stamp duty land tax is typically unavoidable when you're buying an asset, right? When you purchase property, you must pay stamp duty land tax. But because we've set up the company, because the company's bought the asset, and because the company's paid stamp duty land tax, when we sell the company that owns the asset instead of selling the asset out of the company, our future buyer can avoid paying stamp duty land tax, and we can use this as a price advantage at the point of exit as well. And it's typically only applicable, or it is only applicable for investors, but that's also fine. You can still sell the asset out of the company. You can keep the company active, and you can reinvest. Or you can terminate the company depending on what you wish to do. But if you're savvy and if you're efficient in your exit, and you find an investor that's looking to purchase, it can be super tax efficient on both sides. And then lastly, you pay lower capital gains tax. So 4% lower capital gains tax when you sell by way of a share transfer. And yeah, so again, just to kind of reiterate, setting up a company will help you limit your personal liability, assist with inheritance tax, gives you flexibility on exit, but it makes it super tax efficient, which in turn increases your yield, increases your capital gain. And that's for UK and non-UK based. Then just to kind of really, really quickly touch on pricing. And for the purpose of this call, I'm talking about non-UK residents. But at GetGround, it's a pretty straightforward pricing structure. We charge a one-time sign-up fee of £579 plus VAT. With that, we form the company, structure the company, prep all the necessary legal documentation, and create the business account. We then charge an ongoing monthly subscription of £29 a month for one property or one company, and then £45 a month for two or more. and that's not inclusive of that. So again, if you're setting up one company, or if you have one property in a company, £29. For two or more, it's £45. It's capped there at £45. So you can have three properties in the company. You can set up three companies with us, depending on what you wish. And it's £45 a month. And with that, we look after all the accounting, tax return, dividend admin, secretarial services, post management, and as I was saying, management of the registered office address. So again, it's super cost effective. If we're, in comparison to the alternatives in the market, we're give or take 10 times more cost effective. So that's everything from myself. Brief overview of GetGround, what it is that we do, and how you can invest efficiently and invest smart through company structures. Thank you so much.
Thanks, Conor. That was really, really helpful. I think, look, whenever we're venturing into purchasing property into the UK, tax is a question that obviously always comes up, and to be able to have an expert like Conor and his team at GetGround to be able to advise on the most efficient way to purchase that property is super, super helpful. So as I think, as Conor's mentioned about the clients, I mean, more and more of my clients now are using GetGround, as it is deemed to be in many people's eyes the best way to sort of purchase property and in the most tax efficient way. Look, I'd like to thank you all for joining us today. Thank you very much for Conor for his expertise. For everything that we discussed, anything, whether it be more detail on the GetGround, whether it be more information on one of the projects, a little bit more of a conversation about the general market, one of the team will be in touch with you all to just say thank you for joining and to be able to answer any questions. So thanks again, and we will hopefully all speak very soon.
Thanks very much. Thanks, Elliot, for having me on, and thanks everyone for joining.
Thanks. Bye.